Are covered calls really all they're hyped up to be? In today's video, I'm going to show you some of the live covered calls that I'm in and how I'm playing them. Yo, what is going on, Premium Chasers? I hope you're having a God-blessed day today. A very special giveaway to one lucky commenter. You're going to get a free week trial to our weekly wheel picks, where I send you a direct email to your inbox with all of the top plays I'm monitoring for that week with detailed breakdown, so you know exactly how I'm picking those out. So if you want to win that weekly trial to weekly wheel picks, just drop a comment down below on today's video and hit that like button and that subscribe button. But guys, today we're talking about specifically about covered calls. Are they as amazing as they get hyped up to be here, especially on YouTube and all over the place? And then most importantly, how to play them, and most importantly, how not to play them. So let's go over the shoulder. So we're here in our public portfolio right now, and you can see I have a Kraft Heinz covered call right now, okay? Now, this covered call is basically saying, hey, if Kraft Heinz on October 31st is trading at $27, right, I am going to sell my shares for $27. Now, the biggest risk of a covered call is that you are essentially capping your upside completely, right? So with a covered call, if Kraft Heinz here is trading at 28, 29, 30 at close on October 31st, I'm missing out on all that upside. That's just the name of the game. I am selling my shares at 27. I miss out on any further ones. Now, on the flip side, let's say Kraft Heinz is trading at 26, 25, anything below 27 at close on the 31st, I don't have to sell my shares. My shares are returned back to me to then run the covered call. Now, I have this fully on my trade log here. You guys can see this is my covered call here, and my cost basis actually is 27, no premium factored in. Obviously, it's a lower than that, but you can see I locked up my $2,700, $2,700 being my cost basis for my shares at 27, and I sold a covered call exactly at the same strike price just to get that money moving, and I got just about a 2% ROI on my collateral in a month, and that's my plan to keep doing monthly. You're essentially manufacturing like an additional dividend on a monthly basis for you. Now, with that said, this is what this channel is all about. It's all about transparency. Pete, give us the full scenario, right? We have a couple scenarios that I want to share with you right now. So let me go show you Kraft Heinz right now, right? And then let's just show everything's transparent, and I hope you guys like it because that's what this is about. Take a look at Kraft Heinz right now. Trading at $24.91, well below my $27 covered call. Right now, I could come in here, right, and close out my position. I could buy to close this position out for basically like what, $20, about $20, if that, even probably less, right, and be able to get my shares back. Now, would I do that right now? Would I do that? Absolutely not. Why wouldn't I do that? Well, because if I go to, let's just use Robin because it's more visually appealing. If I go to Kraft Heinz right now, let's pretend, I closed out my covered call. We'll just say I paid $10, right? $10 to close this position out. Let me just lower all these so the math looks normal. Listen, guys, I ain't got no video editor here. Come on now. So I gave $10 back of my premium. I'm netting $40.33, which gives me my 1.5% return in basically a 2-week time, right? That's fantastic in my opinion. However, right now, let's say I wanted to immediately do a covered call again on Kraft Heinz after close today. Let the time we record this. I just go 32 days out, right? And I'm looking at the calls. I've got barely anything here. Right, I've got a $41 covered call, 41 call that I could do here, which honestly isn't bad with the 2022 delta, right? I have a 28 that's paying $20, which is hardly anything considering I'm trying to hit my 2% ROI on collateral goal. So to me, it's not worth giving back that $10 of premium today, okay? Now, that's not to say tomorrow, depending on what the market's doing, that I wouldn't do something like that, but right now, it doesn't necessarily make sense for me. I'm personally in this situation because of Kraft Heinz and where it's trading at currently, I'm going to let this go towards expiration, okay? Because I don't really have a juicy enough play to be able to do a $27 call again and hit my ROI and collateral goal. As you see, I would only get about $40 of premium on that if I gave $10 back. And it's funny, the math exactly worked out that way. So to me, it's not necessarily worth it. I want a little bit more. So what's my play here? Well, it's simple, guys, right? Right now, Kraft Heinz, along with a lot of stocks on the markets, are creating lots of opportunities for us for cash secured puts. We're in a bit of a dare I say, I don't even want to say season, we're in a days, like a few days where cash secured puts are reigning supreme. Right now, cash secured puts there's a lot of great opportunities out there. Right now, the past, since April, really, since our recovery in mid-April, right, we've been able to be doing and leveraging our covered calls, right? So with a Kraft Heinz right now, what am I waiting for? Well, right here, I'm waiting for a green day primarily. Right now, I don't need to time it towards that top Bollinger Band. In a perfect scenario, right, when it's at the top of the Bollinger Band, we're selling our covered calls. When we're at the bottom Bollinger Band, we're selling our cash secured puts. That way, we're not really ever taking assignment both ways, or at least mitigating our chances of it, because we usually like to stay in between the Bollinger Bands, okay? Now, with that said, I'm not going to wait, right, with my covered calls, right? And I think that's one of the biggest mistakes people do with covered calls is they sit there, they have them sitting in their account, right? It's trading above their cost or lower than their cost basis, right? And they're not doing their covered calls. Like, why not, right? Like, why wouldn't you go and do your covered calls and collect that income for yourself? It's insanity that people don't, right? You're essentially creating an extra, even if it is, let's say 1%, right? An extra 1% a month factored into like a Kraft Heinz dividend that I'm getting as well. That's fantastic in my opinion. A 1% a month ROI on collateral, obviously not financial advice, results will 100% vary. Options trading is of course risky, but guys, like for a 1% return on a safer stock, in my opinion, like Kraft Heinz, I'm very happy with. Now for me, obviously with the public portfolio, I want this to have a little bit more entertainment value, grow a little bit faster, so I'm being a little bit more aggressive than I normally would be. And also, if you do want this trade log, plus learn more about our Ark Options Strategy and Mastermind and Mentorship program, which is amazing if you're a non-toxic person, click that first link in the description of today's video for that. But with that said, what am I doing with Kraft Heinz? Well, I'm waiting for a little bit of a green day. Now, as we are approaching our October 31st, we still have about over 2 weeks to that date, which is absolutely fine. If we see a green day and I'm able to close out for 10, perfect. But then I want to be able to do a $27 put that's at least going to pay me that $50 to $60 for my $27 calls. Or if it's paying me less, like a 1.5, I want the 28s. Why would I want the 28s? Because I would want my appreciation sale, right? Let's say I made an extra $50 in appreciation sale, or $100, sorry, in appreciation sale. That bumps me up drastically higher, because when I'm selling a covered call, I assume assignment. I'm just assuming it. If I sell cash secured, I'm assuming assignment, right? I'm always assuming assignment. A lot of people don't think of that. You have to be prepared. Otherwise, don't run covered calls. If you're not prepared to sell your shares, do not run covered calls. Like, that's like number one rule. Pretend like when you do that covered call, you just sold your shares for that price. Listen, and trust me, I get it. You're locking you're capping your upside on your gains. But in my opinion, I'm treating this like a business. And I'm going to sleep well at night, knowing that I sold, right? I bought low and I sold high. So I'm not stressing about that. With that said, let me show you guys another example, right? So you guys saw me, I showed Pfizer. Oftentimes, covered calls for me, guys, I leave those bad boys to expiration. Now, is that right? Is that wrong? I don't know. It works for me, right? For example, Pfizer right here. Look, it was at its bottom Bollinger Band here, and let's say you did a 20 cash secured put. Quite literally, the next day it shot up to 27. You could have closed out your cash secured puts that next day and probably made a juiced up, locked up 60 to 70% of the premium you collected on that cash secured put. Fantastic, love it, love it. Well, drop the amens when you love it when that happens. When the next day you could close out your cash secured put. Is there anything better than that? And I swear it happens so much more frequently, especially with this administration, which makes it a lot more fun with selling options, because usually we're not very adrenaline. This isn't an adrenaline pumping strategy. But with that said, right, let's say you did a covered call, right, like right around here. It was heading towards the top Bollinger Band. It's at 25, and you're like, yo, hits the top Bollinger Band. All right, let me get 27 covered calls in, right? Let's say you did a $27 covered call, right? It stayed around this $27 level for a couple days, right? And then took a dump back to 24. Now, what do we do? All right, we have these covered calls that are at 27, right? They're pretty much at this point, most likely, you could probably close out for a decent ROI. But in my opinion, what would be the point? what would be the point of closing out? Because especially if you got in here, you probably made, like a 3 to 4% ROI on your collateral, right? And then since it dropped literally a couple days later to that 24 range, right? You could close out your covered calls, but you're not going to have anything to do with those covered with those shares right now, right? You're not going to get 27, 28, 29 calls anymore. You're not going to get those. Now you could, but the premiums are going to be absolutely awful for them because we're again not trading towards that top Bollinger Band anymore. Okay, you got to consider those things. Now, with that said, let's say your cost basis is around like $20 with your Pfizer. Well, let's say that's the case. Let's say that's the case. Your cost basis with a Pfizer is around $20. It shot up here. You did your 27 calls. You closed them out, and now you do like 25 or 26 covered calls, right around that top Bollinger Band area. Then yes, you could do that. But me personally, what I usually like to do is like on a red day, I always want to sell my calls on a green day. Like even if it's not even like a big green day, but I'd be patient. I would monitor it throughout the day and see, hey, where is Pfizer going to go, right? We're just barely red, so we could probably do the covered calls if we really wanted to, because we're right at that midpoint of the RSI, right? Midpoint of the Bollinger Band. So, we could still get away with it, but your premiums and your strike prices are going to a lot better. Like if this just gets up to a little bit up in the green, like closer to that 25 price of 24.90 or something, which it very well may do at the towards this day if you're monitoring it. Now, we're not full-time traders here or anything like that. We're not glued to charts, but I'm just showing you the possibilities, right? That if you do take your option selling a little bit more seriously, right, and you are like paying attention, you can really make this pretty lucrative for yourself. I mean, look at this. This over just the span of a few day period, this was a fantastic play that could have been played on both sides. But the thing is, you got to make sure you're kind of like in the market. But that's not to deter you guys that do this kind of like, honestly, more like me, where I'm not necessarily trying to be glued to charts. And I do take it a lot more seriously than most people. Obviously, I create content here. I'm involved in our communities, right? I see a lot what other people are doing. But with that said, don't let it deter you from selling options. I believe this is something anybody can do with 30 minutes to an hour a week, absolutely top. So if you want to learn more about our Mastermind Mentorship program, right, how you can join our year-long incubator program, where it is filled with incredible individuals sharing insights, sharing what they're doing, both new people and veterans alike, just for learning a little bit more. I'll give you my completely free trade log as well. So click that first link in the description of today's video, guys. Remember, sell options, collect premiums, repeat. I'll see y'all tomorrow.